We're focusing on flexible spending accounts, or FSAs, and health reimbursement arrangements, known as HRAs, a critical topic for your National Health Insurance Licensing exam. Both allow for tax-free reimbursement of qualified medical expenses, but the exam will test you mercilessly on their differences. Let's start with the FSA. For 2026, the maximum employee contribution to a Health FSA is $3,400. This is an employee-funded account, meaning the money comes directly from your paycheck on a pre-tax basis. The most heavily tested concept with FSAs is the use it or lose it rule. Any money left in the account at the end of the plan year is generally forfeited to the employer. However, employers can offer one of two exceptions, but never both. They can offer a grace period of up to 2.5 months to spend the remaining funds, or they can permit a carryover. For 2026, the maximum carryover amount is $680. An exam question might describe a scenario where an employee has $700 left. If their plan allows the maximum carryover, they can roll over $680, but they will forfeit the remaining $20. There is also a Dependent Care FSA, which for 2026, as a result of the OBBBA legislation, allows for contributions up to $7,500 per household, a significant increase from the previous $5,000 limit. Now let's pivot to the Health Reimbursement Arrangement, or HRA. The number one rule to remember for the exam is that an HRA is funded 100% by the employer. The employee cannot contribute. This is a major distinction. The employer determines the contribution amount and what expenses are eligible for reimbursement. Unlike an FSA, HRA funds can generally be rolled over from year to year without a specific limit, which is a significant advantage. The biggest exam trap is confusing the features of FSAs, HRAs, and HSAs. The key differentiator is ownership and portability. FSAs and HRAs are employer-owned. If you leave your job, you lose the money. An HSA, on the other hand, is owned by the employee and is fully portable, just like a personal savings account. Another critical distinction is that only an HSA requires the individual to be enrolled in a high-deductible health plan. FSAs and HRAs have no such requirement. To keep this straight, use this mnemonic. FSA is for forfeiting funds you don't use. HRA is the employer's reimbursement arrangement that can roll over, and HSA is your own savings account that you can take when you scoot. The exam will test these funding, ownership, and rollover rules through scenario-based questions, so mastering these distinctions is essential for passing. For free practice questions, AI-powered explanations, and more exam prep tools, visit openexamprep.com. That's openexamprep, all one word, .com.